Good morning and welcome back to the Opportunistic Trader for Monday, August 20th. I hope all had a very good weekend. It was very nice weather down in Florida, not too hot. Enjoyed the weekend. Happy to be back at work. It should be a kind of slow week on the news front. Really nothing at the front end of the week. We have ECB minutes and FOMC minutes later in the week, and an event that used to be big, but not as big anymore, is Jackson Hole. We have Fed speak out of there. Powell will be speaking on Friday. Pricing in the market's not expecting very much, so we'll keep an eye on that. Overnight in Asia, very, very quiet. Markets were slightly down again in China and slightly up in Japan. China's down close to 20% on the year. It's down 19.75, which obviously is, if not considered in a bear market, is on the money side in a bear market. Over in Europe, markets open kind of flat, but the DAX has rallied about 120 points, so it's stronger. Our S&Ps are pricing in 350 on the S&P, which is probably about a $4 premium. Not looking for much. The Dow futures are implied about 45 to 50 higher. Across the bond market, bond once again is defying gravity, but kind of makes sense, and will be interesting to hear from Adam from Movement Capital, who looks at our commitment of trader data.
Should we expect less or more volatility as the week goes on? Do you think?
I would guess that the answer would be they're not. A couple of years back, I know Yellen made some comments, and before that, Bernanke, and they were market moving, especially when we came into the easing policy. But I think it's pretty clear now that Powell is tight. The market kind of knows that. It's ignoring that. So I wouldn't expect any position squaring going into that. Maybe some, downside put buying, but people feel as though that's a waste of money. We're at 12 volatility, so that tells the story.
Right.
But interesting, every time we have a 1% down move in S&Ps, the volatility moves like 25%. It's a very interesting concept. So we haven't really had too many 2% down days, but I'd be interested to see what volatility will actually do when we go down 2% in a day and then maybe open lower the next day. That'll be interesting. I had a question just I trade gold a little bit, but obviously you're our expert on the space. And, my question is, usually, like, if I was trading gold, I'd be looking at the dollar, and there are certain things maybe I would look at equities as risk on, risk off, but the market seems to be very, very different. I just think it's like a curious thought to what is moving the market, how you look at it. Is it really flows out of South America? What do you think the thought is for someone that's looking at gold that would want to trade this thing, and what you think the right things are to look at?
That's actually a good point, and something I think a lot of people don't notice. The dollar is obviously the primary long-term driver behind gold, because it's priced in dollars. So if you're looking at gold priced in dollars, the first thing you want to throw out when you're looking at gold, at least I've been taught and it has served me well, is the fundamentals. When an analyst gets up there talking about production and supply and above ground, that's meaningless, especially for active traders. If gold is nothing else, if it's not money, if you want to say gold is nothing, what it is it's a hedge against fear of human behavior. So people buy and sell gold based on their fear of counterparty risk, based on their fear of honesty. It actually is kind of like more of a VIX than VIX is. So it's actually moving with the VIX. What it historically, and I think this is important, for the last 5 years, the gold price has been very closely tied to the U.S. dollar, Japanese yen pairing, FX pairing. Secular stuff aside, which actually does involve fundamentals, if you're looking at gold historically, say for the last 5 years as an active trader, you're looking at the yen-dollar pairing. If you're looking at gold for the last 3 weeks, actually since the tariff talk started, gold stopped behaving as it should with the yen-dollar and started taking its direction from, remember, it's an emotional product. It really is kind of like a proxy for what people are worried about. So gold started taking its cues from the Chinese yuan. And basically, as the yuan weakens, if you want to put the story on it for the Bloomberg headline, as the yuan weakens, the Chinese have lesser buying power for gold in dollars, and they lower their bids.
But we will see everyone in the chat room. Good luck today.
Thank you.